We continue with our question. In this question, a business trade receivables account showed a year-end balance of 47,440. It has been decided that amounts totaling 340 should be written off as bad debts. The specific allowance was to be made against an amount of 400 from DECO, and the general allowance of 2% was to be made against the remaining bad debts. The requirement again is to calculate the allowance for receivables shown in the statement of financial position, and to calculate the bad and doubtful debt expense is shown in the statement of financial, in the income statement. So we have our T account. Our opening balance of trade receivables is 47,440. We write off the 340 bad debt expense account, bad debt expense. Since this bad debt, we are certain it will not be paid, so we have to reduce our trade receivables. We then have the specific debt of 400. So from the closing balance of 47,100, we're going to subtract the 400. Subtract the 400, and then the balance 46,700. We apply the general bad debt expense of 2%, which gives us 934. So the 934 plus the 400 will be the total allowance for receivables, which will take to the allowance for receivable accounts. So 400 plus 934 will give us 1,334. This will take to the bad debt or doubtful debt expense account, which gets closed up in this income statement with a total of 1674, being the 340 which has been written off as bad debt, in the 1334 which has been expensed as specific and general expense allowance. That concludes this example. We now look at various aspects of where questions may come from in the exams. First, we look at effects of subsequent periods. You may find yourself in a situation where a bad debt which you had written off last year because the customer was unable to pay, but the customer becomes lucky in the following year. They are able to raise some money and they come back to you and they make the payment. If the bad debt is recovered which had previously been written off, it is credited to the bad debt expense account, because this is the account to which it was originally written off. So you are going to reverse the original write-off entry. So So your accounting treatment will be now to debit cash since you have received the cash, credit receivable, trade receivables to reduce your trade receivables. Since this amount had been written off from trade receivables, you are going to debit the trade receivables and credit the bad debt expense, which will go and increase your profit in the P&L account. So if we follow through from the previous example, FightCo from previous example subsequently receives a check of 7,000 from Ali. Ali was one of the customers who had initially not been able to pay, and we had written off the 7,000 which Ali owned. Now Ali comes back in the following year and pays us the amount which we had written off earlier. So we're required to show the accounting treatment in the relevant T accounts. You recall that our trade receivable after the write-off of Ali and Tyson were the closing balance of 50,000. So the bad debt expense account we had debited the income statement earlier on. We are now going to credit the bad debt expense account with the 7,000 cash which has been received. Then we debit cash, the 7,000, to indicate that cash has come in with the contra in the bad debt expense account. We look at another situation. Doubtful debts specific allowance last year, customer pays outstanding amount this year. In this situation, a credit entry for the cash is made to the trade receivables account because the debt is still included in the total trade receivables account. You recall that for a doubtful debt, we do not write off the doubtful debt from the trade receivables, but instead we do open an allowance for receivables. So it's this allowance for receivables which we have to close up, okay, by removing the allowance from the allowance account and crediting the bad debt expense account, which will go and increase the profit in the P&L, since earlier when we created the doubtful debt accounts we had reduced the profit through the doubtful debt expense account. Then the cash which has been received will be debited to the cash account, and the trade receivable will now be written off by crediting the trade receivable account in the statement of financial position. The next scenario is where a doubtful debt specific allowance last year goes bad this year. Since the doubtful debt has not been written off from the trade receivables account, we now have to remove it from the trade receivables account, since it's definite that it has become bad. The allowance account that we created has to be closed So we debit the allowance for receivables and credit the trade receivables account to write off this doubtful debt, which is no longer recoverable. We now look at a doubtful debt general allowance. The allowance is usually charged at the end of each period to reflect the change in value of the total trade receivables. Since this is not to a specific customer but to the percentage applied to the total trade receivables after writing off bad debt expenses and specific doubtful debts. So the accounting treatment will be to remove the opening allowance. This we do by debiting the allowance for receivables and crediting the doubtful debt expense, then replacing with the closing allowance, which would be to debit the doubtful debt expense and credit the allowance for receivables. This will effectively either reduce the allowance or increase the allowance depending on the circumstances or what you are given in the question. But the bottom line is that the allowance has to be reviewed every year end to determine whether the allowance should still continue to be carried as an allowance or whether the allowance should be written off entirely or the allowance should be increased or the allowance should be reduced. We demonstrate this in our last example of this lecture video. At 30 September 2007, GECO had an allowance for receivables of 24,000. During the year ended 30 September 2008, GECO recovered 2,000 from a customer whose balance was written off in 2007 and wrote off further debt totaling 18,000. The closing allowance for receivable is required to be 21,000. No allowance has been made for this information. Okay, so you notice that the allowance, the opening allowance was 24, but the closing allowance should now be 21, indicating a reduction in the allowance. But on top of that, there was a debt which had previously been written off to the income statement, which has now been recovered of 2,000. So this 2,000 is going to increase our profit. But we also have a debt totaling 18,000, which we have to write off. So the 18,000 will reduce our profit in the income statement. On the other hand, since the allowance is reducing from 24,000 to 21,000, the allowance, the reduction in the allowance will also increase our profit and loss in the income statement. So the allowance balance will now be 21,000. In the income statement, we'll have 2,000 credit and 3,000 credit in the debit of 18,000. So our income statement will be reduced with a reduction in the profit of $18,000. That brings us to the end of this lecture video as to encourage you to listen to it over and over, because irrecoverable debts and doubtful debt is one area which students find to be quite challenging. So listen to the video over and over and practice as many questions from the ref kit. Now do not practice once. Go through the questions over and over until you are comfortable with allowances, how to treat allowances. Because this same knowledge on allowances, you are going to need it as well when you come to look at provisions. Thank you and good luck in your exams.